Welcome back to my investment portfolio channel, where I'm going to be taking a look at the top winners and the top losers this week, talking about what type of news caused them to move in the direction that they did. I'll also quickly go over the pies that I've split my portfolio into and see if they've been performing as I have expected them. In today's video, I'm also going to be diving into Tesla's inclusion into the S&P 500 and see how this will benefit them. But first, let's check over my pies. So my pies are in good shape at the moment, not too much to complain about. I've actually been doing some shuffling about in them. So in my dividends pie, I bit the bullet and took out Cisco. And not for any reason relating to their business, I still think they are a great company. But I just wanted dividend payers that had a rich history of paying dividends. And Cisco was still in their early years. I think they've only been paying dividends for like 9 to 10 years now. So I just wanted companies that were a little bit more experienced in that field. In my growth pie, it's possibly where more dramatic changes happened. I took out Apple and Microsoft because they were pretty well covered in my tech ETF, and at this point it was like I'm doubling down on the same few stocks and I don't want to do that too much in my portfolio. I also took out Nvidia because I preferred AMD's growth trajectory, and it's also covered in I think 2 or 3 of my ETFs, so that was a bit overkill. And then in my growth pie, I also added Grow Generation and Celsius Holdings. I'm pretty sure I'm missing out on some, but if you want to take a look at my pies, they are always in the description. And in my investment account, no changes there, just the same old. Right, so Tesla is back in the news this week after NIO and other Chinese EV companies took the spotlight for a bit. So after posting 5 consecutive quarters of profit, Tesla will be admitted into the S&P 500 index on the 21st of December. Analysts at Goldman Sachs said of the 189 large cap core funds in our universe, 157 funds that manage around 500 billion in assets under management did not hold Tesla on September the 30th. Assuming those funds chose to hold the car maker at benchmark weight, they would need to buy $8 billion of the stock, or about 2% of Tesla's market value. In layman's terms, a lot of those funds like Vanguard, who mean to track the S&P 500 index as close as possible, will need to buy Tesla shares in order to do so. By the way, I'm not saying Vanguard need to buy more Tesla shares, I'm just using them as a fund manager example. The purchases of these shares will most likely drive prices up. It might be difficult to tell if these price actions are already priced in though, because a couple of months ago many people were expecting Tesla's inclusion, so from that point on those people could have already made their move. It could also be challenging to make way for Tesla in these big fund managers' portfolios, because it could mean they would have to sell a substantial amount of another or a number of other companies to make way for Tesla. Some people say that it's turning the S&P 500 into a momentum index. Others are saying that they had no choice but to include them, and that it solidifies the direction in which the world is heading. Some analysts predict that their stock price gains from this will be short-lived, because when companies typically join the index, they get a temporary price boost before other factors take over. Personally, for me, I'm disinterested in this whole scenario. I'm more focused on seeing if Tesla are able to reduce operational cost and rely less on regulatory credits to drive their earnings. I'm still long on Tesla, but for me those are the things I care about the most financially. They have their own story going on, which will ultimately unlink them from their inclusion within this index, so this is a situation I'm not too fussed about. Roku is my other top performer this week after climbing 15%. This was brought about by an analyst at Pivotal Research Group who increased their price target from $75 to $240 for the stock, and also increasing from a sell to neutral. It seems like the upgrade was inspired by John Malone's positive commentary about Roku and how it's in a position to eliminate normal TV. Maybe not eliminate entirely, but you get what I mean. The pandemic has no doubt helped to accelerate the stock's price growth, but Roku seems to be set up to have a long-term profitable global business. There's also news that Roku may strike a deal with HBO Max, which will most likely benefit their stock price. Now, I'm not necessarily investing in Roku because of the gains it's seen due to the pandemic, but because of its long-term positioning to essentially replace traditional television. And the reason I chose it over Netflix is because I just prefer their financials. They look much healthier. Realty Income down 5% for me this week, and I don't actually know why. I haven't seen any contributing news that would have catalyzed this, so I'm just going to blame it on the normal market movements. The pandemic has obviously affected them, and they're yet to recover back to their pre-pandemic levels, but yeah, I'm not going to lose sleep over this drop. My other loser this week was Mastercard. They had risen from quite a low recently following good vaccination news, and yeah, similarly to Realty Income, there wasn't any news that would have suggested a fall in the stock price, so once again I'm just going to blame it on normal market movements. I feel like it's a good and healthy thing though to see when stocks go down, and especially without any well, that just sounds weird, but let me finish that. It's good to see them go down, especially without any detrimental news, because it shows the lack of overreaction in the market, so Obviously it's not good for a stock price to go down, but it's a normal thing to see. This week was a fairly quiet one, to be honest. Apart from the reshuffling about of my portfolio, I bought some more Alibaba stock as it continued to approach its 200-day moving average. And I also saw that it was incredibly oversold, so I thought, why not trade it, right? Alibaba is a company that I'm pretty confident will do well in the long and short term, so I bought 2 shares in my CFD account, and at the moment it's up by £7.50. Next week I don't think will be that much different in terms of the volume at which I buy shares. However, in terms of trading, I've got American Electric Power, ticker symbol AEP, on my watch list. Similarly to Alibaba, they've fallen pretty hard in the last couple of days and could see a reversal, so I'll be keeping an eye on that. But yeah, I think that's where I'm going to end it. Thanks for watching, and I'll catch you in the next one in a bit.